G'day everyone, welcome back to another episode of the Australian Property Investment Podcast. I'm your host, Aaron Christie David. I run a mortgage broking business called Atelier Wealth, where we specialize in helping property investors start out and scale up their property portfolios. And the idea behind our podcast is really to educate, maybe entertain a little bit, but I do want to stress and emphasize at the start that this is not intended to give advice. And if you do need professional guidance, please seek out someone to pay and find the right professional for your needs. With our episodes, we'd love to bring in people that live, eat, breathe, sleep. Their life revolves around property. And today's guest, their name, you will have heard it before. You have seen it synonymous with investing in property and amassing a large property portfolio, and someone who's helping other investors on their journey. Dilleen, welcome onto the show. How you doing?
Really good, thank you. Thanks so much for having me here. Excited.
No, mate. Thank you very much for being here. I know you're going to bring the energy and, of course, share your journey. And for those that maybe don't know Dilleen, he's someone at a very young age who has amassed a large portfolio. Now I'm talking, and I've pulled this online, Eddie, so you can update this if you like. So age 31, 78 investment properties, $45 million portfolio value, and $125,000 in rental income per month.
Yeah, I've added a couple more since then, but yeah, pretty much it. Yeah, you're right.
They are numbers that will blow most people's mind. And when you think about your story and where you've come from, and I have read your backstory, mate, something that's coming up from Housing Commission to now. So we're not talking about someone that had that leg up in life, for example. We're talking about starting out, I think you're working at McDonald's, right? So starting out, flipping burgers, the hardcore way to get your foot in the door. And then here we are at age 31, where most people may not dream to get to as well. And I think, and this is not to, please, this is not to belittle you, but you'd almost say, look, if you can do it, other people can do it as well, right?
Yeah, for sure. Look, I definitely believe that anyone can do it if they put their mind to it. Like I'm just, I guess, going through a lot of hard times and issues, and I don't know, hard to say, harsh word, but say trauma as a child, growing up in a real rough environment, where, you know, Housing Commission and just like that real rough area where there was just like, you know, literally lived next door to like drug addicts, and houses were getting burnt down. This was grew up in Wilmot in Mount Druitt, which is back in the day was like even worse than it is now. Some people I personally use that as like a fire. Like I use that as motivation to be like, I got to get out of here and I got to get my kids out of here. Like you want to have kids in the future. I don't want to bring them up in this environment, and this kind of sucks right now, but like, what can I do about it? And, you know, a lot of people don't, you know, have that, like turn it into motivation and have that kind of drive to get out of there. But to me, I was like, it sucks right now, but what am I going to do about it? And, you know, how can I get to a better place? If it takes 5-10 years, that's fine. But yeah, I figured that out when I was literally like 13, 14. I'm like, this atmosphere sucks.
I love it. I love it. Show me a bit of hunger in the belly. And that's why I often, you know, look at new migrants, for example, this country, people that go, they want to rewrite their story and rewrite their script. And property can let you do that within one generation. Like within your lifetime, from a 13, 14-year-old with that inkling to a 31-year-old now having kids, you know, mate, you've rewritten that entire script for your bloodline. Like that, to me, when we talk about intergenerational wealth through property, this is what we're talking about.
No, definitely. I completely agree. Like property investing to me is the best vehicle. You know, there's stocks, there's shares, there's crypto, and all that other kind of stuff. But like property, as you know, you get the leverage. You can get leverage, you get tax deductions. Like the government rewards property investors, you know, that you get tax deductions when you own an investment property. You don't really get anything when you own your own home. So like it helps everyone to, you know, invest in property. Well said.
So, mate, what we're going to do is go through our intro. So I start with the 3 Ps, a little about yourself personally, professionally, and your property journey, which we'll come to at the last part. But we're just speaking beforehand about your personal life and 2 small kids. And I'm sure life has changed from what you know it a few years ago to where you are now, mate.
Yeah, definitely. So personally with kids, like the last 3 years, it's just been a massive like change personally. You know, it's just a lot. It's trying to juggle work, business, properties, and kids. It's far more difficult than I could have ever imagined. And I said it earlier, but like to me, like raising kids are harder than doing what I've done, you know, building my property portfolio.
Yeah. Is it because there's not like a playbook as a new dad or new parent, for example, whereas I look at business and you probably get some really good feedback loops and cues going. If I do this will work. Whereas in parenthood, the goalposts are constantly moving as well.
Oh, definitely. And it's like when I was getting very obsessed and like passionate about property investing, when I was like starting to research a lot about it, read all the books,
Yeah.
Rich Dad Poor Dad and all the property books, etc.
Yeah.
That's what I was interested in. So like I've been, learning and doing all that kind of stuff, figuring out property investing for like the last 13, 14, 15 years. But like you don't really think 5 years ahead and read a book about how to be a dad. So like it's like it's not even on the radar.
I agree. And so if you're any new dads that are listening, I've recently just jumped on, I was telling you before, Two Doting Dads podcast, give them a plug, but it's something that I've found. I tell a lot of mates, I'm like, it just, you find something that you go, bit of laughter, lighten the load a little bit as well. And have some, I think that the other part that I pick up, especially talking to a lot of investors, is enjoying the journey. Like most people go, look, Eddie, Dilleen, you've made it, 70, probably almost 80 properties now. It's like, but at some point you had to have enjoyed the journey. And I feel like those early days may have been a little bit more fun and rewarding. Now you go, look, not that there's more to lose, but you've kind of built it now. And you go, well, the fun was at the very start, right? A bit like parenting where you go, these days might feel hard, but they're often the ones that people say cherish these ones the most as well.
Couldn't agree more. I was actually thinking about that the other day. It's like I miss, like I still am on the grind, but like I miss like being like having that kind of like idea of what will happen in the next 5 years? Will I actually make it? Will I actually be able to buy the next property and the next property and the next property?
Yeah.
And then you get to the stage where you've like, you can buy what you want and you can, get the dream house, etc. And you're like, well, what's next? Like, so it satisfies you for a little while and it's good. And it's just, it's I've listened in the past to a lot of, the Tony Robbins and all that kind of, and all that kind of stuff, how it's like progress, no matter what you do, it's like progress is you've got to feel alive. You've got to feel like you're progressing somehow in life.
Yeah. And I think the other part, whether it's business, property, or even parenthood, or touching on that note, is the enjoyment that comes with it as well. I think having that fun, that enjoyment makes the journey worth it. And I feel like that's something that's probably not spoken about enough. It's not, I feel is quite underrated, which is where's the happiness or where's the enjoyment that comes with the contentment of building a quality property portfolio? It's not necessarily quantity, but it's a quality metric as well. And I feel like if we can bring that into the conversation, that will help people go, look, I don't have to be the 1% investor that's got 6 or more properties. I'm happy at the moment with 3. I will get there, but my time will come as well.
Yeah,
so
for sure. Sorry, you go.
No, you finish.
I was going to say, yeah, for sure. And I think even like the book that I've done, which is 30 Properties Before 30, like, which is definitely outdated now, but I think a lot of people take away like the number. It's not all about the number. It is about the quality, as you said. Like you don't have to get 10 or 20 or 30, like even, 4 or 5 or whatever it is, like still, it's a combination, of the quality and quantity, etc. Yeah,
I agree. So let's go through your journey. So kind of take me back from the start. How did you get, and for people that are listening, maybe starting out on their journey going, well, how did you get in? How did you then start to scale up? And what was that real catalyst for you to then really put the accelerator down and propel that journey forward, Eddie?
Yeah, so I first got started. I was working at McDonald's when I was like literally, I got my first job when I was like 13, 14 years old, saving up like $100, $200 a week as an example. When I got to around 20,000 in savings, which took a couple of years, that was when I was about 18 years old. The first property that I bought was on the central coast of New South Wales. So it was around like Tuggeranong, the entrance kind of location. People know that. And I looked there basically because it was the only place that I could afford and the only place that I actually knew other than where I lived in Western Sydney. Because even back then, Western Sydney was still expensive. Like it's still expensive today, but it hasn't, like it's always been expensive. Sydney's always been expensive. So I only had a budget around 140,000. And the only other place I knew was the Central Coast because we used to go holidaying there and camping, which was an affordable kind of holiday, that the only one we could afford. So I bought that property. It was a 2-bedroom unit. Many people said, wait to buy a house, wait another couple of years, save up, buy a house. And I was like, look, it's better to just, which I still firmly believe to this day, it's better to just get in with something when you can, rather than waiting another 1 or 2 or 3 or 4 years, because situations can change. And like, I think you can be thrown off if, something happens. So I bought a 2-bedroom unit for about 138,000. did a 10% deposit, so 13K down roughly. The rest of, I literally had like zero money left. I had about $87 left in my account after that. But thankfully the property was tenanted, and it was tenanted for like 220 per week, which, you know, you work it out as about a 7.5% yield roughly back then. And that was the first one. Like I continued to go about my business, and, you know, was still working at McDonald's, and tried to, you know, be an 18-year-old teenager and all that kind of stuff, go out and party and have fun, but live very frugally as well. And I didn't really buy another property for probably about another year and a half. So that was probably the longest thing. But after that, I started reading, you know, they don't really put them in the magazine stores anymore, but like Australian Property Investor Magazine, that kind of stuff, like Your Investment Property. And I was like, some of these people are like 24, 25, and they've got like 4 or 5 properties. And I'm like, I'm 20. And I'm like, seems like they're doing really well. And then basically I was just like, okay, so you can have more than one. And then I was obviously reading, you know, more of the books like Rich Dad, Poor Dad. And I was like, you know what, let's see, I just want to keep this going, because I had the old school mentality at first, which a lot of people do, as I'm sure you have heard as well. Buy one property, just pay it off, and then buy another one. Where I did the numbers, I was like, it's going to take me X amount of years to pay this off. I'm going to be this age. And then I was like comparing it to like what's in these magazines. I'm like, well, this person, it might take me that long just to pay one off. And then I just obviously figured out the strategy and, you know, about how you can accumulate multiple. I bought the second one in Adelaide, because my dad, when mum and dad pretty much split up and got a divorce, like he moved to Adelaide, and that was another one. That was an affordable area back then. And I bought a house over there, which was about 130,000, semi-detached house around like Salisbury, which everyone was like, do not buy there. It's a terrible area. You know, around like Elizabeth. I'm spewing. I wish I bought 1,000 there, because they've all tripled in value. Like, I'm just kicking myself. Everyone that was like, don't buy. I was going to buy more over there. I have bought about 8 or so in South Australia, which thankfully went up. But like, you just look back and you're like, all the naysayers that said, don't buy there, it's never going to grow, it's a terrible area, like, would have made so much more. But anyway, so that's the first 2.
Excellent. And then I think you're saying, from what I'm hearing, is that you found that those first few are the hardest. And then after that, you found, okay, look, there's some momentum here on your side as well. So then how does your team, you're a young guy, how do you build this team around you of professionals that are going, hey, mate, here's the next step after you? Or is this kind of self-taught and you're challenging people to go, I want to go again?
Yeah, back then didn't really have the team at all, but I'd say it was trial and error a lot on my behalf. And a lot of the time I would I would go to like certain banks, like Commonwealth Bank, St. George, like you could meeting in the branch. Yeah. They were like, you can't service. Because back then I was probably only on like, you know, 50 grand, 55, 45 grand, whatever it is. Yeah. But basically, eventually by doing all those meetings and having those meetings with those things, and even then mortgage brokers, and a lot of mortgage brokers, back then I couldn't get help from, because they didn't want to refinance and pull out like 40K worth of equity from one property, etc., because it wasn't really worth their time, which is understandable now. But eventually I came across like loan to value, like figured out loan to value ratios. And I'm like, okay, so if I can get the valuations of these 2 properties at X amount, then I figured out, you know, how it's common knowledge to everyone now, but you know, the loan to value ratio, how if you can top them up to 80%, release the equity. And then that basically, once I figured out that kind of framework of getting the equity out of these properties, and then, you know, using it to buy more property, because the first 2 was basically just from savings. And then the third and the fourth, which I bought in Brisbane, were basically just by equity that was pulled out of the first 2. It was a combination of equity and savings.
Okay, great. And then having fast forwarded where your journey is to looking back then, a couple of things. One is, would you do anything differently, or would you just go, look, there's a bit of blind, dumb luck, and I'm just going to buy and hope for the best? Or was there some type of methodology that you had in place? Like you're saying, I understand LVRs, but then buying the right property, buying the right location, knowing what those growth metrics were going to be. How did you go about educating yourself on those as well?
I guess if I were to start again, do anything different for that question first, like I would definitely team up with anyone that is a mortgage broker that has a lot of property themselves, that has physically done it themselves. If they've got, you know, 5, 6, 7, 8, 10, then they're going to be able to point you in the right direction. a lot of the meetings with the people at the banks that I originally had, like they didn't have any properties. I found out later on after the fact. So like, no, you should do it this way. And I'm now looking back at it, I'm like, you should have like not interrogated them, but find out if they've actually got the right, knowledge behind them to, point you in the right direction. Because once I started like teaming up with, mortgage brokers and figuring out more about the finance aspect, like, I learned the differences between the bank valuations, of course, which I'm sure a lot of people would know, like the desktops, the drive-bys, the full vals, which ones are going to be more conservative, which ones are going to be more like, in your favor and lenient. So when I started doing a lot of that research and speaking literally with a lot of brokers, they had, 5 or 6 or 10 properties themselves, then I would figure out that, finance kind of, behind the scenes framework, where if I can buy a property, even if it's like 250,000 back then, and you can still pick up affordable properties like that, might be a unit or a townhouse in Perth now, but I can get like a desktop valuation and find out what the bank would literally value it at. Because at the end of the day, to me, by trying to scale that portfolio and use the equity from going from 1 or 2 to 5 or 6 or 10, it's really about what the bank will value it at. Not about what, you think it might be worth, or what about, real estate agent says they might sell it for. If the bank values it at the price, then it's, it's good enough for them, it's good enough for me. So if I buy a property, see a property that can potentially get down for like 250, and I can see a lot of other sales where it's higher, it might be an urgent sale, distress sale, bank repo, whatever it is, a time-sensitive manner. And then I figured out that properties that are tenanted usually are harder to sell. And that's not, I don't believe it's as like talked about, as well known as a lot of people think, but people always talk about distress sales, bank repos, all that kind of stuff. But in my experience with literally negotiating tens of thousands of properties and buying thousands for clients and myself, if a property is tenanted and it's mixed with that other fact that the seller has to sell pretty urgently, it's going to be very hard and usually be able to get it for a discounted price. Because if it's like a recent example is, picked up a property for like 350 because it had a tenant in there for the next like 8-9 months on a fixed lease. The seller of that needed to sell in the next month or two. It was like not negotiable. They were going through like a situation where they had to sell. They had a tenant in place for the next like 9 months, and they had like 2 other offers on the table for like 40, 50, 55,000 more, but they're all from people who wanted to move in and didn't want to wait 9 months.
Yeah.
So it's like when I meet like those special situations mixed with, working with a broker that could like be like, yep, this just valued up at, let's say 350, and you pick it up for 250. So 100 grand on the way into it, or like 30-40% without even waiting for the market to grow.
And so how are you doing that research then now? So if you're looking at your checklist and we'll go into this in terms of your what you're doing from your buyer's agency side, how are you doing that research to go, these are the people that are highly motivated. We know how we can negotiate, like a pro, for example. This is where our data is suggesting the market value is, and this is a great offer. How does that stack up when you explain that to a client for you guys, Eddie?
Sorry, the first question was, how do you find them? Or
so when you're doing your due diligence and your research, how are you then going about pulling this data together? What are your data points and data sources?
Right. Okay. So I think in order to get access to a lot of those properties, like it's a lot of repetition, it's a lot of building up relationships. So like we were buying not like 90% over the last like 3, 4, 5 years in Brisbane, which now you probably noticed the Brisbane market's gone through that massive growth cycle, which it seemed like it would never come, but then it finally did. Now we're buying a lot in Perth. So like within, those 2 markets, especially, like I'll always first like to kind of lead by example and buy and test out a market before I would ever recommend it to any client. So when I was buying in Brisbane for clients, like I've been investing in that property in that market for like, 4, 5, 6 years prior anyway. So I knew everything there was to know about it. I knew all the locations. A lot of the agents and the people that I negotiated properties from originally when I was building my own portfolio, like I bought 10 or 12 there in Brisbane before I even started helping others. Basically, it takes a lot of time, but if you can build up, relationships with real estate agents by first building their trust and actually buying a property through them. So you might not be able to get the best property in the world from day one. It might be the 3rd or the 4th or the 5th, where you've built up kind of, knowledge and relationship with, 5 or 6 or 7 or 100 different real estate agents that you've literally called about maybe existing properties that they have maybe online, and then you kind of not interrogate them, but try to find out what other listings they've got coming available over the next week. And if you buy one or two, when I've started to buy one or two from them, then they really saw me as like a serious player. And they'd be like, I've got another one coming up. I've got another one coming up. And they would literally bring, so like 80, even 90% of the properties we probably like pick up to this day are usually not on Real Estate or Domain. But the first one or two, like, you know, transactions, or even the first 1 or 2 years of doing that, you've got to literally be like everyone else and just literally, you know, call every single listing that's online and try to get the background information of, you know, is this property tenanted? Are they motivated? And if the agent says, look, they're not like, they want to get the highest price, they don't have a particular time frame in selling, well, then they're not going to be motivated enough to really do that deal. Whereas if like out of, let's say you call 20 or 30, which is a lot of work, of course, but if you call 20 or 30, and then maybe 1 or 2 of them are like, they need to sell literally within the next 45 days because of XYZ reason, then you know you've got a situation there that may play in your favor. And they don't have the time to wait for the tenant moves out, you know, do a paint job, do the professional marketing, make it really present really well, they would literally get a higher price. So it's repetition, and you've got to literally, you know, do the hard yards and contact 20, 30, 40 agents just to hopefully get 1 or 2 opportunities that make sense.
I appreciate that. And I guess that's when we talk to buyers agents, really that secret sauce comes down to not only a trained eye for the type of property, but then the art of the negotiation as well, which is when people, and you probably see this time and time again, Eddie, when people try to take it on themselves, and like you're coming up against real estate agents who are trained negotiators. And if you can't fight fire with fire, then I guess you're on the back foot a little bit as well. Whereas you're doing this daily, you've got those relationships built as well. They know your name. So you're dealing like a wholesaler versus a consumer or a DIY investors, maybe more retail, really, isn't it?
Definitely. And it's like, even a lot of people don't understand, you know, the back end of how a real estate agent will actually put a property online. Like they'll put a property online for 500,000 asking price. Like, where does that number come from? They could pick it out literally out of the air. They could put it on for, it could be worth even more than 500,000, and it could be listed at 500,000. Like I've seen agents like literally pick up their phone and like change a price, you know, instantly. Like if a property's worth 500,000, they could list it at $1 million. And someone like a novice or a beginner starting there, even if they put an offer in of like, let's say 700,000 and it's listed at $1 million, and they're thinking that getting 300,000 off, they could still be paying 200K too much. So it's like to me, it's very basic stuff, but it is like, no one teaches this stuff. You don't learn it in school. It just takes years and decades of like, you know, learning the back end of, you know, how property actually goes up for sale.
Yeah, nice one. You mentioned before about your book. I want to come back to that. So what was it? 30 before 30, but you're kind of 31 with 80 properties. So that I'd say that trajectory is just skyrocketed. But take me through, like when you look at the average first home buyer age in Australia, we're talking about the age being 37. So how are you, and this may be what the secret source of the book, how are young Australians, I guess, building that confidence to go, I can amass a quality or quantity property portfolio before I get to 30? Because I'm sure it's probably like a common pushback that you're getting, going, either I don't have the deposit or I don't have the borrowing capacity. How do I get into the market, and how do I grow my portfolio?
Yeah, so I think starting off taking bite-sized pieces is definitely the way to go. Starting off small. It's exactly what I did. You can still get in with, you know, utilize LMI as an example. I know some people are against it, but my first property was a 10% deposit, and you know, now there's some lenders, as I'm sure you know, that do offer 5%. Their interest rates obviously will be a lot higher, and you will pay more LMI, etc. But it is possible. So if a person's, you know, young, if they're, you know, 21, 22, 19, whatever it is, like you can get started with an investment property still today. I wouldn't be buying, like, it's about purely thinking about the numbers and trying to make money from an investment perspective. So if you live in Melbourne or Sydney, you probably think it's impossible to buy, you know, $1 million property right away. I'm only on, you know, 45 or 50 grand or whatever it is. But I'm right now buying properties in Perth for clients, and I bought a lot of properties. I still occasionally buy the little cheapie that is a really good value as well. I bought a property in Perth in a suburb called Mossman Park in Perth.
Yeah.
Usually don't throw around the suburbs because everyone will be like, oh, that's the secret suburb. But there's no such thing as about the secret suburb. It's like, it's the first, what is the state that is realistically going to have the most growth in the short and long term, and also mixed with which state is going to have the best rental yields to back it up this second as well. And that's why Perth, as you probably know, like you pick up affordable properties, it's more affordable than Adelaide, and it's double the size now, double the population. So picked up a property there in Mossman Park. It was like just a unit, small block, like a 30-year-old unit. But Mossman Park houses sell for like the median price is like 1.5, 1.6. So it's an expensive area. It's right near like south of Cottesloe, which is like basically like the Manly Bondi of Perth. Very expensive location. This unit, 210,000. Picked it up. Literally like 3 or 4 months ago, I actually showed it to like 4 or 5 clients. They're like, Eddie, I don't want to buy that property. It's too small. It's a 1-bedroom unit. It was 1 bed, 1 bath, 1 car, but it was still about 59 square meters, as you know, the square meter kind of thing it makes. So you could do, I showed it to a young client, and I was like, you could do like a 10% deposit on this, or 5% worst case. And 10% of that is 21,000. So similar thing, if someone was literally starting off how I did, working at Macca's, I saved up $200 a week, 2 years, had 20K. That's a 10% deposit on a property today in 2023. And that property actually got rented out for 400 a week. Nice. So massive yield, like 9% yield, and it was 210K, and just a really good kind of buy.
There you go. And I guess that's a great example. And the first thing people will hear is, don't buy apartments, buy land, for example. Whereas you're a little bit more agnostic. You go, look, I don't really care if it's an apartment, townhouse, villa, freestanding home. If the numbers make sense, we're going to execute, for example. So take me through. Are you buying location? Don't worry about the property type. We're buying on the best streets. How does that then drill down to your numbers where you said, hey, that makes sense, that particular acquisition, whereas other properties we're going to say no to?
Yeah, so I'd say the 3 keys, which I kind of narrowed down to, which seems very basic in saying them, but it's extremely hard to do, is buying a property that is actually below what other ones are selling for, or below market value. People call it below bank valuation is another thing. And that's by looking at, which takes a lot of experience to do, but looking at recent comparable sales, looking at properties on the market now also that are listed for sale. And the second thing would be buying in a market that is prone to a lot of capital growth and, forecasted to go through a lot of capital growth over the short term, not waiting for anyone can say, buying in any state long-term will have capital growth, because of course, realistically over long term, it will have capital growth. But timing the cycle is what I also try to do mixed in with that capital growth. So like, I believe I timed the cycle in Brisbane perfectly. Like I was talking about Brisbane in 2017, 2018 before the cycle, and everyone was like, you're crazy. Brisbane's like hasn't grown in like 9 years. And then over like 2019 to now, it's like doubled. Everything doubled. Houses, units, townhouses. I used to show people townhouses in like Logan and Ipswich in 2019, 170,000. And everyone's like, why are you showing me this stuff? It's like terrible. Like it's never going to grow. I want to buy a house, etc. And the same 170K property is like 400,000 like 3 years later. So in terms of percentage value, they've grown more than Bondi in the last 3 years. They've like outperformed Bondi in like the expensive like Sydney suburbs, like so much more. But I would say the 3 things, buying below market value, buying in a strong capital growth location, and buying with a really good rental yield. So they've got to tick all 3 boxes. And I'd rather buy, as an example, in my portfolio, I've got a mix of like houses, townhouses, and units, villas, commercial properties too. But everyone sticks with 90% of people I speak to now. They're like, I've been told from, this person, always buy a house, buy the land. Yeah. I'm like, well, what if your budget's 300,000? And I would rather buy a property. You can pick up a townhouse now, as an example, in Perth for like 300K, rent it out for like 500 a week, 7 kilometers from the city. I would rather buy in a really good location for 300K which is like blue chip, where you're 7 kilometers from the city, where you've got 2 million people living there. Because for 300K, you buy a house, you're going to buy regional. You're going to buy, out in the middle of nowhere, where you got 20,000, 30,000, 50,000 people, which is okay to do. I get it, but I wouldn't do it. I'd rather pick up a really good location, 10 kilometers, 15 kilometers in a major capital city, where you've got, compared to a regional, you've got 2 million people versus 100,000 people.
Yeah. It does go against the grain a little bit, because most people don't look, buy the house, buy the land. That's what it appreciates. And you're saying, look, buy the location, because that's something that's going to be highly sought after.
Yeah. Like if units didn't grow, then, why are units in Bondi, 1.3 million for a one bedroom unit in Bondi? Yeah. If units like and townhouses didn't grow, then why is a townhouse in Sydney in the inner west 1.5 million?
Yeah.
And the same thing in Brisbane and Adelaide and all that kind of stuff. So like, despite they grow in value as well, because like 30 years ago you could buy a townhouse for 30, 40 years ago you buy a townhouse for $8,000.
Yeah.
A townhouse is $1 million in some locations. So they obviously still grow. And ironically, I tell this story a lot. The first property I ever bought, that was a 2-bedroom unit. I actually inspected a house on the same street the same day, and I was like, man, I wish I could afford this. Has a backyard, 450,000. That property was, I inspected, like 100 meters away from the unit I bought. Fast forward 13, 14 years, the houses are now selling for like 950, 900, between 900 to a million, which in a percentage value, as you could probably figure out, 450 to 900, 950.
Doubled.
They've doubled. Some of them might be a million, but say 110%, 120%. The unit I bought for 138, I've got valued at 450. So the percentage value is just like, you would never expect it. The percentage value, the unit I got valued at 450 at the same time where the houses are, and that's where I was like, it's not just the land, it's not just the house. Sometimes it comes down to affordability. In some location, people can't afford $1 million, but they can afford 450. So like the unit technically went up in a percentage value, 250% roughly.
Yeah.
But the house went up like 120%. So it's actually outperformed it in terms of percentage growth, which I've seen time and time again. So that's where I learned, like in some locations, it obviously doesn't happen everywhere, but in some locations you can have units and townhouses in affordable locations grow, if not more than houses sometimes.
Yeah. Thanks for sharing it. I really appreciate that. If you go back, and I think you bought that first property around 2008. So we're talking around GFC time, for example, and people go, look, not the best time. So you got all these naysayers going, not the right time. Rates were rising at the time, for example, as well. And we're in a kind of similar-ish market where we've seen, quite a few rate rises, and now investors that maybe bought a few years ago are really feeling that pinch. What are your conversations at the moment around for newer investors going, look, I think rates are high. We're not sure where the market's going. Is there some volatility? Should I sit and wait? And then you got other investors who are feeling the squeeze. What type of conversations are you having to those investors at the moment, Eddie?
Well, I'd say in terms of interest rates, I would say, look, in terms of the 3 keys, which is under market value, growth, and yield, like the yield's a big part of it. If you can still pick up a property that has like an 8% yield and the interest rate 6.8% or 6.5%, whatever it may be, then you still have a decent buffer. Like it might not be positive cash flow or positively geared, but it would still be relatively neutral after cash rates, water rates, management fees. And if interest rates, I think you probably heard it but even before I did, but they're predicting them to come down next year. Hopefully they do.
Yeah.
But looking back on the research over the last 20, 30 years, usually after they've raised them multiple times, usually 18, 24 months, they start to trickle down a little bit at least. So to me, it's about, if you can invest in the hard times, then when it does get a little bit easier, the cash flow is going to be a lot more, in your favor and better. And of course, with buying, the other strategy, which is, part of it, which is buying under what other ones are selling for. Like if, people are a bit hesitant of the market, if you can pick up a property for, let's say, 450,000, maybe it's obviously not in Sydney or Melbourne, but if you can buy it in Brisbane or, Adelaide or Perth in an affordable market, but if you pick it up for 450 when you see other ones selling for 500, 520, well, then worst case, even if the market did come back by 5 or 10%, you bought at 450, it was really worth 520. So you're still technically ahead. So you're not just, this strategy isn't about just trying to leapfrog and get to the next one, It's actually part, to protect yourself in case of further interest rate rises, and in case of the market did come back 10%, you'd still be okay not in a negative equity position. And yeah, so there's always, like, if you stick to those three keys, like, they can spin off 1,000 different, ways of how it kind of protects you, and how it also, and of course, buying existing. Like, to me, I've always would only buy existing properties. Not a fan of, flogging people properties off the plan or anything like that, which are overpriced. So
yeah, thanks very much. And I guess for you, two small kids, large portfolio. What's the game here, Eddie? Like, what's the strategy? What's the long game look like for yourself as well?
I guess it changes every 1 to 2 years. Like, when I've started realizing that, like, no matter what goal you set, once you hit it, it'll satisfy you for a little while, a month or 2 months, or maybe even a day or two. Then you'll set another goal. So then I realize there's, like, and some people are like, oh, you build a portfolio because then you're going to retire. Then you just retire, lay on the beach. And coming from, I never believed when I've heard people say, well, you don't want, like, you're not going to want to retire, or you're not going to want to, like, you always need something to do. So it's a constant need for that progression, to feel like you're accomplishing something. But I guess property investing does give you those options. If you don't want to work 6 days a week, maybe you just work 3 days a week or 2 days a week. But to me, I'm going to always continually try to build my portfolio. I'm passionate about that, and always, continually try to, help others with building their portfolio and pass on the knowledge that I've learned, as much as possible. And, just really try to enjoy life along the way with the kids and the family and everything like that, and try to be healthy as well.
Good on you. I love that, mate. And that's a really nice way to kind of wrap up, which is the happiness, the enjoyment, the contentment, and also the family. I guess and Barcy, I say it a lot, health doesn't matter how many properties you have, your health is going to become number one. And then the enjoyment of the people you're sharing it with is a number two. So you can have all the property in the world, but I've seen some fairly miserable investors, and I see some really confident, some really happy property investors. And I think that's where they're getting their sense of enjoyment from, is they've enjoyed the journey. They're loving the people that they're sharing the journey with as well. And then also being able to share your knowledge, insights with that next generation of investors becomes super important for paying it forward as well. So I want to say thank you very much for your time and your energy, Eddie. I really appreciate it. If you do want to reach out to the team at Dilleen, we'll include their details to get in touch. You can do your research. Like I say, with all buyers agents, we kind of bring them in so we can have a chat to them, get to understand their philosophy and see who you connect with. So we take that kind of heavy lifting of research off your back. And that's what we love to do here at the Australian Property Investment Podcast. So Eddie, I want to say thank you very much. Great to have you on. And I look forward to seeing your journey in that next chapter unfold, buddy. Thanks.
Thank you so much. Great to be here. Thank you so much again. I look forward to seeing you next time.
Good on you. Thanks very much. That's a wrap for another episode of the Australian Property Investment Podcast. If you found it helpful, please leave us a review. Even better, if you want to drop us some questions that you'd love to have answered in future episodes. And until next time, take care. Thanks.